In 1977, a young fund manager took over an obscure investment fund worth just $18 million. Over the next 13 years, Peter Lynch turned that modest fund into a $14 billion financial titan, producing an extraordinary 2% annual return that crushed every professional on Wall Street. Yet, his most shocking secret wasn't a supercomputer, a secret algorithm, or insider connections. His secret was that ordinary, everyday shoppers, using basic common sense at local retail stores, have a massive structural edge over every multi-billion-dollar fund manager in Manhattan. By the time you finish this video, you will master the exact step-by-step framework Peter Lynch used to spot multi-bagger stocks long before the pros, and avoid the deadly financial traps that wipe out 90% of retail investors. When Peter Lynch updated his masterwork for the Millennium Edition, the stock market had just witnessed the greatest decade of wealth creation in human history. The Dow Jones jumped from 2,400 to over 11, wealth creating $25 trillion in brand new wealth across the globe. Yet inside that explosive boom, millions of retail investors lost their life savings chasing hyped-up internet stocks that didn't have a single dollar in profits. Lynch openly admitted his own vulnerability, revealing how his technophobia caused him to miss Amazon in 1997 because he only looked for retail stores and physical shopping malls. Amazon went up tenfold in a single year, proving that even legendary stock pickers miss massive winners, but stick strictly to what they understand. While walking through the quiet coastal villages of County Kerry, Ireland, Lynch reflected on where real financial insight actually comes from. He realized that great stock ideas don't originate inside institutional glass towers in New York or London. They come from observing local businesses, watching which shops have lines out the door, and noticing what products people actually use and love every day. Stock picking is not a secret priesthood. It is an open-air discipline of observation, curiosity, and basic financial checks. Peter Lynch's investing journey began at age 11, carrying heavy golf bags at Braeburn Country Club near Boston after his father passed away. Listening to corporate executives converse between holes, he earned enough caddy tips to buy his very first stock, an air freight carrier called Flying Tiger Line at $7 per share. The stock skyrocketed to $32, paying for Lynch's entire college tuition at Boston College. That early win taught him a profound lesson. Superior returns don't come from luck. They come from paying attention to emerging industry shifts long before the general public. When Lynch arrived at the prestigious Wharton Business School for his MBA, he encountered a stark contradiction. Professors preached the efficient market hypothesis and the random walk theory, claiming that stock prices are always perfectly priced and impossible to beat. Lynch found academic finance theory completely useless for actual stock picking. While academia treated stocks as random statistical tickers, Lynch viewed them as fractional ownership pieces of real, breathing businesses that produce profits or losses. Lynch coined the term the Wall Street oxymorons to describe institutional money managers trapped in corporate bureaucracy. If a fund manager loses $10 million buying a safe blue chip like IBM, nobody fires them. It's considered an acceptable market loss. But if that same manager invests in an unknown, highly profitable small-cap company and it dips 10%, their boss fires them immediately. Institutional investors are constrained by rigid rules, board approvals, and career self-preservation, forcing them to buy safe consensus stocks long after the real profits have passed. This institutional paralysis creates what Lynch calls street lag. By the time a Wall Street research committee approves a stock, 40 analysts have published research, pension funds have bought in, and the stock has already multiplied 5 to 10 times. You, as an individual investor, can walk into a local store, see a breakout product, and buy shares months or years before Wall Street analysts even initiate coverage. Your speed and independence are your greatest financial weapons. Is stock investing just legalized gambling? Lynch answers with a decisive no, but only if you understand the mathematics of expected value. In a casino, the house edge guarantees that the longer you play, the more money you are mathematically proven to lose. In the stock market, corporate earnings growth flips the odds in favor of the patient investor. Over century-long horizons, stocks have delivered roughly 10% annualized returns, vastly outperforming bonds and cash. Lynch compares stock selection to playing 7-card stud poker. As each new quarterly report and balance sheet unfolds like a new card on the table, smart investors constantly recalculate their odds. When the story deteriorates, you fold your weak hands and cut your losses. When a company's balance sheet and earnings strengthen, you increase your bet, maximizing gains on your highest conviction holdings. Before buying a single share of stock, Lynch mandates passing the three-question mirror test. Question number 1. Do you own a home? Housing is the single best investment most individuals ever make because it is a 5-to-1 leveraged asset where people do rigorous research, inspect the neighborhood, and don't panic sell during minor price dips. If investors treated stocks with the same patient long-term mindset they apply to real estate, their stock portfolios would perform infinitely better. Question number 2. Do you need this money to survive? Never invest money required for next year's college tuition, mortgage payments, or emergency medical needs into the stock market. When you invest short-term survival cash, fear forces you to sell at the absolute worst possible moment during market dips. Only invest capital you can leave untouched for 3 to 5 years minimum. Question number 3. Do you have the emotional temperament to succeed in stocks? Every investor will face severe market corrections where their portfolio drops 20, 30, or 50%. If your natural reaction to a market drop is panic and selling, you will consistently lose money in equities. True stock market success requires the stomach to view market downturns as rare buying opportunities, not reasons to run for cover. Lynch's advice on market timing is blunt and unforgettable. Is this a good market? Please don't ask. Trying to predict interest rates, recessions, or GNP growth is a complete waste of human energy. The market will cycle through booms and busts, but great individual businesses continue growing their earnings regardless of macro headlines. Focus on bottom-up stock selection, not top-down economic speculation. Lynch highlights Wall Street's dismal track record in economic forecasting. Wall Street firms employ thousands of PhD economists, yet not a single one predicted the major 1981 recession or the 1987 stock market crash. Lynch calls them cockroach forecasters, always predicting doom that never materializes when expected. Instead of guessing macroeconomic weather, look for companies that thrive in any environment. Let me summarize part 1 of the Peter Lynch framework. First, Wall Street pros are shackled by career risk and institutional bureaucracy. Second, pass the mirror test before investing $1. Third, stop trying to time the market. Your edge isn't access to secret Bloomberg terminals. It's your daily boots-on-the-ground observation of real business performance. Now, let's move into part 2, where Lynch reveals how to classify every stock into 6 distinct categories and stock the legendary Tenbagger. Before you buy a single stock, you must classify it into one of 6 specific categories, because each category requires a completely different buying, holding, and selling strategy. Treating a cyclical stock like a fast grower is the single fastest way to lose money in the market. Let's break down how to stalk the ultimate prize, the Tenbagger. A Tenbagger is Peter Lynch's signature term, borrowed from baseball, describing a stock that pays back 10 times your original investment. Just 1 or 2 Tenbaggers in a portfolio of 10 stocks can transform average performance into extraordinary wealth creation. Tenbaggers aren't found in high-risk speculative penny stocks. They are found in mundane, rapidly expanding consumer businesses right under your nose. Lynch's most famous Tenbagger discovery came straight from his own home. His wife Carolyn brought home Legs pantyhose, bought directly at the supermarket register in plastic egg containers. She loved the convenience and quality. Lynch checked the financials of parent company Hanes, verified massive profit margins, and bought the stock long before Wall Street paid attention. It became one of Magellan's biggest winning stocks. Lynch repeated this consumer discovery process over and over. He noticed packed parking lots at Dunkin' Donuts, exceptional fast food unit economics at Taco Bell, and booming auto parts sales at Pep Boys. Each time, he verified store expansion metrics and fundamental numbers before investing, turning everyday observation into massive portfolio gains. You don't need a PhD in finance. You just need eyes and basic balance sheet verification. Category number 1, the slow growers. Slow growers expand at 2 to 4% annually, roughly matching overall GDP growth. These are mature, older corporations that no longer reinvest heavily in expansion, but pay generous, regular dividends. Lynch rarely kept large positions in slow growers because they lack the earnings velocity needed to drive Tenbagger returns. Category number 2, The Stalwarts. Stalwarts are multi-billion-dollar corporate behemoths growing earnings at 10 to 12% per year. Stalwarts are defensive anchors. They offer 30 to 50% gains in good times and protect your capital during recessions. Lynch always kept a portion of Magellan and Stalwarts to buffer against market downturns. Category number 3, the fast growers. Peter Lynch's absolute favorite category. Fast growers are small, aggressive companies growing earnings at 20 to 25% per year. Warning: Lynch cautions against companies growing faster than 30% because hypergrowth attracts brutal competition and operational burnout. A well-managed 20% grower can compound into a 20-bagger over a single decade. Category number 4, the Cyclicals. Cyclicals are companies whose sales and profits rise and fall in predictable macroeconomic waves, such as automakers, steel manufacturers, and airlines. Buying a cyclical at the peak of the economic cycle when the PE looks deceptively low is a fatal mistake. Cyclicals require precise timing, buying when earnings are depressed and selling when cyclical profits peak. Category number 5, the turnarounds. Turnaround stocks are battered, near-bankrupt companies restructuring their operations or benefiting from government bailouts. In 1982, Chrysler looked dead, but loan guarantees and new minivan models allowed it to surge from $6 to over $60 per share. Turnarounds operate independently of the general market, delivering massive non-correlated gains. Category number 6, the asset plays. An asset play is a company sitting on valuable hidden assets that Wall Street analysts have completely overlooked. This could be prime real estate acquired decades ago, recorded at historic cost, timberland reserves, patent portfolios, or massive net cash piles. Eventually, management or an activist investor unlocks that hidden asset value for shareholders. In Chapter 8, Lynch reveals 13 attributes of the absolute perfect stock. Attribute 1. It sounds dull or silly, like automatic data processing or Pep Boys. Attribute 2. It does something dull, like Crown Cork and Seal making tin bottle caps. Attribute 3. It does something disagreeable or disgusting, like Safety Clean Recycling oily shop rags or Service Corp International operating funeral homes. Disgusting and boring businesses scare away fancy Wall Street analysts, leaving the high-margin profits entirely for you. Attribute 4. It's a spin-off. Parent companies spin off subsidiaries with clean balance sheets and deeply motivated executive management. Attribute 5. Institutions don't own it, and analysts don't follow it. If zero pension funds own the stock, you're early. Attribute 6. Rumors abound about toxic waste or depressing operations, keeping conservative funds away while earnings quietly compound. Low institutional ownership guarantees huge buying surges when Wall Street finally wakes up. Attribute 7. It's in a no-growth industry. High-growth industries invite fierce venture capital competition, while no-growth industries let established leaders dominate quietly. Attribute 8. It has an exclusive niche or moat, like a local gravel quarry that holds a regional monopoly. Attribute 9. People have to keep buying it. Consumable, recurring items like coffee, razor blades, and pharmaceuticals. Attribute 10. It's a user of technology, like supermarket chains using barcode scanners to cut labor costs, rather than selling competitive hardware. Attribute 11. Insiders are buying shares with their own cash. Insiders might sell shares for many personal reasons, but they only buy for one single reason. They know the stock price is undervalued. Attribute 12. The company is buying back its own shares, shrinking share count and driving up earnings per share automatically. When a company buys back its shares, your percentage ownership of the business increases without spending another penny. Now, Chapter 9. The 6 toxic stock red flags you must avoid. Red flag. Number 1. The hottest stock in the hottest industry. High-flying stocks backed by immense media hype and zero profits attract massive competition and inevitably implode. If everyone on television is raving about an industry, you're already too late. Red flag number 2. Beware the next IBM, next Apple, or next McDonald's. The copycat sequel almost never succeeds. Red flag number 3. Beware of diversification. When great cash-generating companies buy unrelated, unprofitable businesses instead of paying dividends or buying back stock. Lynch watched oil giants squander billions buying department stores, destroying shareholder value overnight. Red flag number 4. The whisper stock. Speculative microcaps promising revolution without earnings. Red flag number 5. The middleman trap. Companies vulnerable to being cut out by suppliers or customers. Red flag number 6. Single customer dependency. Suppliers that rely on one giant customer for over 25% of sales. If that single customer demands lower prices or cancels the contract, the supplier goes bankrupt overnight. In Chapter 10, Lynch establishes the fundamental law of stock pricing. Earnings determine stock prices. You can look at chart patterns, interest rates, or market sentiment, but over any 5 to 10 year period, a company's stock price will follow its earnings per share. If earnings double, the stock price doubles. If earnings collapse, the stock price collapses. Never buy a stock without first inspecting its line of earnings. The price-to-earnings ratio, or PE, tells you how many dollars you are paying for every $1 of current earnings. A stock trading at $20 per share with $2 in earnings has a PE ratio of 10. A high PE means investors expect huge future growth, while a low PE means the market expects slow growth or trouble. Always compare a stock's PE to its historical average and its industry peers. Here is Peter Lynch's golden valuation formula, the PEG ratio. Divide the PE ratio by the annual earnings growth rate. If a company has a PE of 15 and is growing earnings at 30% per year, its PEG ratio is 0.5, a screaming bargain. If the PEG ratio is above 2.0, the stock is dangerously overpriced, regardless of how popular it is. In Chapter 11, Lynch mandates the 2-minute drill before placing any trade. Before you buy a stock, you must be able to deliver a 2-minute monologue explaining exactly why you own it, what category it belongs to, and what specific catalyst will drive future earnings. If you can't explain it to a 10-year-old in simple language, you don't understand the investment. Never buy a stock based on a vague tip without passing the 2-minute drill. Fieldwork is where retail investors win. Lynch regularly visited stores, ate at restaurant franchises, and inspected product displays. Are customers enthusiastic? Are checkout registers packed? Is management opening new locations with cash flow or debt? Your personal channel checks give you real-time fundamental data months before quarterly earnings releases. In Chapter 12, Lynch encourages contacting investor relations directly. Individual investors have the right to call company investor relations representatives to ask factual operational questions. Ask about inventory buildups, debt refinancing schedules, or expansion timelines. Combine annual 10K report analysis with direct inquiries to verify management's story. Chapter 13 presents 10 critical financial metrics every stock picker must audit. Metric 1. Percent of sales. How much does the breakthrough product actually contribute to total company revenue? When Procter & Gamble launched Pampers, it was a revolutionary product, but it was only a tiny fraction of P&G's total sales. Look for breakout products that represent a massive percentage of overall revenues. Metric 3. Net cash position. Calculate net cash per share by subtracting long-term debt from cash reserves and dividing by total shares. If a $12 stock has $6 in net cash per share, you are buying the underlying operating business for just $6. Metric 4. Debt load. A heavy debt balance sheet is lethal during economic downturns. Metric 5. Dividends and dividend safety. Dividends provide regular income and support stock prices during declines. However, beware of abnormally high dividend yields in shaky cyclical businesses, where earnings can't cover payout obligations. A dividend cut triggers massive panic selling and destroys capital quickly. Metric 6. Stated book value versus real book value. Reported book value on balance sheets can be deeply deceptive. Land acquired decades ago is recorded at historic cost, hiding massive real asset value. Metric 7. Free cash flow. Prefer companies that generate rivers of free cash without needing constant capital expenditures. Metric 8. Inventory versus sales growth. Peter Lynch's favorite early warning red flag. If a company's inventories increase by 30% while sales only grow by 10%, danger lies ahead. Unsold goods piling up in warehouses will force deep price write-downs, destroying future quarterly earnings. Always verify that sales growth outpaces inventory growth. Metric 9. Organic growth rate. Seek companies expanding through higher unit sales and store openings, not price inflation alone. Metric 10. Net bottom line profit margins. High-margin companies have a protective cushion during recessions, while low-margin, razor-thin businesses face immediate bankruptcy when costs rise. Auditing these 10 numbers turns guesswork into institutional-grade conviction. In Chapter 14, Lynch emphasizes continuous monitoring, rechecking the story. Every 6 months, re-examine your holdings just as if you were discovering them for the first time. Has a fast grower's store saturation reached its limit? Is debt rising in a turnaround? Are inventories piling up in a cyclical? Investing is a dynamic process. Update your thesis when facts change. Chapter 15 synthesizes the entire analysis into the final checklist. Audit PE relative to growth. Check insider buying. Verify debt structures, and ensure you understand the business model completely. If a stock fails the checklist, walk away regardless of market excitement. Disciplined filtering separates market winners from emotional gamblers. Let's summarize Acts 2 and 3. Categorize your stock. Look for boring, disagreeable moats. Audit the 10 famous numbers, and execute the 2-minute drill before buying. Now, in Part 3, Lynch reveals portfolio architecture, when to buy and sell, and the 12 deadliest market myths that ruin investors. Here is the major midpoint pivot of Peter Lynch's philosophy. The greatest danger in investing isn't lack of information. It's the false comfort of following the crowd. True outperformance requires stepping away from consensus blue chips, trusting your own ground-level observations, and maintaining long-term discipline. In Chapter 16, Lynch tackles portfolio design. How many stocks should you own? Lynch recommends owning between 3 and 10 stocks. Owning 50 stocks creates diversification, making it impossible to track individual business fundamentals. Distribute capital across fast growers for upside, stalwarts for stability, and turnarounds for opportunistic leaps. Lynch introduces one of his most famous portfolio rules: don't cut the flowers to water the weeds. Many investors sell their best-winning stocks to lock in small gains and pour that capital into failing, decliner stocks hoping for a rebound. Lynch calls this cutting your flowers to water your weeds. Let your winners run and prune fundamental losers aggressively. In Chapter 17, Lynch identifies the absolute best times to buy stocks. First, during December year-end tax loss selling, when investors dump beaten-down stocks indiscriminately for tax deductions, creating extreme bargains. Second, during market panics, crashes, and collapses, when panic drives exceptional businesses down to absurd valuations. Market crashes are rare gift sales for long-term stock pickers. When should you sell? Lynch provides explicit category-based sell signals. Sell slow growers when they lose market share, costs rise, or dividend safety breaks down. Sell stalwarts when their PE ratio climbs far above historical norms, or when management begins diversifying into unrelated businesses. Sell based on fundamental valuation overreach, not stock price charts. Sell cyclicals near the peak of the economic cycle, when inventories build up, commodity prices drop, and PE ratios look deceptively low. Sell turnarounds after the recovery has taken place, debt is paid off, and earnings have normalized. Once a turnaround has turned around, reclassify it as a stalwart or sell. For fast growers, sell when store opening expansion decelerates. Same-store sales turn negative and executive talent departs. When a fast-growing retail chain runs out of new cities to expand into, its hypergrowth phase ends. If the market re-rates a fast grower into a slow grower, the stock price can fall 50% even while earnings remain flat. Recognizing store saturation protects your accumulated Tenbagger gains. Chapter 18 exposes 12 dangerous myths about stock prices. Myth 1. If it's gone down this far already, it can't go any lower. Polaroid fell from $143 to $14 and then collapsed to zero. Myth 2. If it's gone this high already, how can it possibly go higher? Exceptional companies like Philip Morris rose 100-fold despite decades of naysayers. Myth 3. It's $3 a share. How much can I lose? Whether a stock is $3 or $300. If the company goes bankrupt, you lose exactly 100% of your capital. Myth 4. Eventually, they always come back. Thousands of companies, including Penn Central and Eastern Airlines, never came back. Myth 5. It's always darkest before the dawn. Sometimes it gets completely pitch black before going to absolute zero. Myth 6. When it rebounds to $10, I'll sell. This is psychological anchoring. The stock doesn't know you bought it at $10. Evaluate the company on current fundamentals, not your cost basis. Myth 7. What do I care? Conservative stocks don't fluctuate. Even electric utilities and conservative blue chips can face bankruptcy under bad management and rising debt. Myth 8. It's taking too long. Nothing is ever going to happen. Stock prices can lag corporate fundamental improvements for 3 to 5 years before catching up overnight. Myth 9. Look at all the money I lost because I didn't buy it. Fantasizing about unearned gains on stocks you never owned is a path to reckless gambling. Myth 10. I missed that one. I'll catch the next one. Buying a second-rate copycat company usually leads to regret. Stick to original market leaders. Myth 11. The stock went up, so I must be right. Myth 12. The stock went down, so I must be wrong. Short-term stock price movements are driven by market noise and sentiment, not fundamental validation. Judge your success by corporate earnings growth, not daily ticker fluctuations. In Chapter 19, Lynch warns sternly against options, futures, and short selling. Call options and futures are zero-sum speculative bets with rapidly expiring time decay, designed to transfer retail money to institutional market makers. Shorting stocks carries unlimited loss potential while capping upside at 100%. Stick to buying and owning great physical companies for the long term. In Chapter 20, Lynch delivers a timeless truth. Consensus opinion is frequently wrong. 50,000 Wall Street experts can be completely wrong at major turning points. Over multi-decade horizons, equities have consistently beaten bonds, cash, and gold. Patience and fundamental discipline are the ultimate wealth generators. In the epilogue, Lynch reflects on October 19, 1987, Black Monday, when the stock market crashed 22.6% in a single day. While pundits panicked and foretold a new Great Depression, Lynch reviewed the balance sheets of his holdings, verified that fundamental business values remained intact, and stayed fully invested. Within months, the market rebounded and surged to new historic highs. Never let temporary panic scare you out of extraordinary businesses. Let's summarize Peter Lynch's top golden rules of stock picking. 1. Know what you own and why you own it. 2. Look for boring, disagreeable companies with niche moats. 3. Stock prices always follow earnings. 4. Never cut your flowers to water your weeds. 5. Invest in what you understand and verify with financial numbers before buying. These rules are timeless principles for financial independence. The next multi-billion-dollar Tenbagger stock is already out there right now, operating in a local mall, a crowded restaurant, or a grimy industrial plant. You don't need Wall Street's permission to find it. You just need open eyes, a 2-minute drill, and the patience to hold. If this comprehensive breakdown brought you value, hit the like button, subscribe for more elite book summaries, and drop a comment below with your favorite Peter Lynch lesson. Thank you for watching, and keep one up on Wall Street.